Bearish engulfing pattern, definition and example of how to use. In technical analysis, the bearish engulfing pattern is a chart pattern that can signal a reversal in an upward price trend. Comprising two consecutive candles, the pattern features a smaller bullish candle followed by a larger bearish candle that engulfs the first. This formation is considered a strong indicator that the prior upward momentum is waning and a reversal is on the horizon. Traders can use the bearish engulfing pattern as a signal to initiate short positions. Typically, a stop loss is set just above the high of the engulfing candle, the top of the second one, to mitigate risk. While the pattern is considered powerful for identifying market reversals, it's more effective when used with other technical indicators like the Relative Strength Index, RSI, the Moving Average Convergence Divergence, MACD, or volume analysis. As such, the chart pattern can be more valuable in a diversified trading strategy. Interpreting the bearish engulfing pattern, the chart pattern can be a warning sign signaling a potential reversal from a bullish, upward, to a bearish, downward, trend. The bearish engulfing pattern indicates a sudden shift in market sentiment when the sellers have overtaken the buyers. The appearance of a bearish engulfing pattern after an uptrend suggests that the bullish or ascending momentum is weakening. The bearish engulfing pattern has several implications. The pattern is often an early indicator that a downtrend may be on the horizon. For investors holding long positions, the pattern can be a signal to consider exiting or to tighten stop-loss levels. Additionally, for traders shorting the asset or the market, this pattern can mark a good entry point, although additional confirmation is typically needed. While the pattern is a bearish signal, it is prudent to confirm it with other technical indicators like moving averages or the RSI. A stop loss above the high of the engulfing candle is often placed to manage risk at this point. Also, the pattern's reliability depends in part on its position within broader trends, the volume during the pattern, and the price action that follows. The psychology behind the bearish engulfing pattern. The psychology behind the bearish engulfing pattern helps understand the shifting dynamics between the buyers and the sellers in the market. Let's look at what the bearish engulfing pattern might indicate. Initially, there is optimism. The pattern usually occurs after a period of upward price movement, indicating that buyers have been in control. The small bullish candle that forms initially suggests buyers still expect the upward trend to continue. There is then a turning point. The appearance of a large bearish candle that engulfs the previous bullish candle, the second candle's high is higher, and the low is lower than the previous one, signals a change in sentiment. The engulfing bearish candle indicates that the sellers have not only entered the market but have done so with enough force to overshadow the previous candle's gains. Fear now sets in. For those holding long positions, the bearish engulfing candle could prompt some to sell and exit their positions. Coincidentally, bearish traders would see this as an opportunity to enter short positions, expecting the price to decrease. Now, confirmation is sought. Both bears and bulls may seek additional assurance that the pattern means what it suggests. Bulls may hesitate to buy more, while bears may look for further signs of weakness before shorting. If the price continues to move downward after the pattern, this would validate the bearish sentiment, which could reinforce a cycle of selling. The bearish engulfing pattern suggests a psychological tug-of-war between optimism and pessimism, confidence and fear. Its appearance could mark a pivotal moment when the balance of power shifts from buyers to sellers and a downtrend begins. Understanding this psychology helps make more informed decisions and manage risk effectively. Trading the bearish engulfing pattern. The bearish engulfing pattern can be a critical technical signal in financial charts that heralds a potential reversal from bullish to bearish sentiment in the market. This pattern can have an important role in guiding traders' decisions, but like all technical indicators, it should be used with other tools and with a clear understanding of its implications. The bearish engulfing pattern typically appears at the end of an uptrend, signaling a potential reversal in price direction. It can be seen as more significant when there is a high trading volume during the bearish candle period. For further validation, traders can wait for a subsequent bearish candle in the next trading session. Another strong confirmation comes from a gap down, which means the opening price of a trading session is lower than the closing price of the previous session. Additional technical tools like moving averages, RSI, or the MACD could be used to confirm the bearish signal. For example, a crossover in MACD or an RSI heading below 70 could be additional confirmation. Also, if the pattern occurs near a known support level and the price breaks below it, that's often considered strong confirmation. When acting on this pattern, traders typically initiate a short position after they've confirmed the bearish signal, setting a stop loss above the highest point of the engulfing candle, potentially curtailing a financial setback. Alternatively, to save any gains as the price decreases, some traders employ a trailing stop, an order set at a percentage or dollar amount below the market price, which adjusts as the price increases, ensuring gains are locked in. However, it's worth noting that, as with all trading strategies, there's no guarantee of success. The bearish engulfing pattern can be misleading. This is why traders consider a stop loss crucial. If the pattern fails, traders can then re-evaluate the market conditions. A failed bearish signal could indicate underlying strength in the asset, and it isn't the right time to go short. A setup that doesn't pan out can be emotionally taxing. Investors and traders find it best, then, to stick to a well-defined plan and not let emotions dictate actions. The pros and cons of using the bearish engulfing pattern. Pros: early warning system, simple to identify, highly versatile, risk management, stronger confirmation. Cons: false signals, depends on context, lagging indicator, requires confirmation, emotional pitfalls. How do I confirm the bearish engulfing pattern signal? Improving the reliability of the bearish engulfing pattern signal involves a multifaceted approach that incorporates additional technical indicators, contextual analysis, and risk management strategies. By integrating additional layers of analysis and risk management, you can improve the reliability of the bearish engulfing pattern as a bearish signal. It should be noted that no single indicator should be used in isolation. A well-rounded strategy often involves several forms of analysis for more robust decision-making.